right. So fractional reserve banking is important because it has a lot to do with how bank tiers are created, how new loans or new assets and new debt is created, how much a bank can create, and how often that they can do it, right? So this quote here, each and every time a bank makes a loan, new bank credit is created. New deposits, brand new money. Graham Towers was a governor on the board of the Central Bank of Canada, and that couldn't be any more truer even for in America. So most Americans think that banks lend out their money. In actuality, banks create brand new debt from thin air. Every time you pay back debt, you're actually transforming this brand new debt or asset into currency or reserve for the bank. So every loan is cash flow from you to the bank. This here talks about bank assets and bank liabilities. And just to confirm what I'm saying here, if you look at it, it says here that the assets are items that the banks own. That's one very important thing that the bank owns. This includes loans, securities, and reserves. All right. So loans are assets that create this cash flow coming back. Securities is when they take loans or credit lines or different things like that. They package it and sell it off, or people invest in them and pay, and they get paid from that way. Reserves, they get paid for holding reserves, which are not your deposits or your bank accounts or anything like that. They get paid for holding reserves as far as like through interest for that. Liabilities are the items that the bank owes. So that's money going out. This is when they borrow money from other banks, etc. All right. So banks once lent the money in deposits. After a while, laws changed with the need for more money and moderate inflation. Banks needed to create more money to keep the economy going and their doors open. Laws changed again, then banks only needed 10% in deposit. Example, if you went and deposited $1,000 into the bank is not going to lend out, $900 or something like that. That $1,000 stays there, and what they're going to do is they're going to create a brand new $10,000, lend that out, right? Today, loans do not depend on deposits, so banks just create brand new money whenever you ask, right? If banks don't do this, they will fail and close. Transactional bank accounts provide quick and easy access to your money, right? So the money in transactional accounts can be accessed by checks, electronic transfers, ATM withdrawals, debit card payments. This type of account requires a 10% reserve. Banks are required to keep on hand certain amounts of cash by depositors, but banks are not required to keep the full total amount that is deposited. Some banks are exempt from holding any reserves, but all banks are paid interest on the reserves they do have. So that's what makes the reserves an asset. All right. Banks that offer non-transactional accounts like savings, retirement planning, wealth management, money market accounts, IRAs, 401ks, and annuities have more leverage to lend because these accounts do not require the 10% reserve. All right, so banks with less than 16.3 million in assets are not required to hold reserves at all. Okay. Assets again are loans, securities, reserves, anything that brings in money. Banks with assets less than 124.2 million, but more than 16.3 million, they have a 3% reserve requirement, right? And then banks with more than 124.2 million, they have a 10% reserve requirement.